and welcome. I'm Melanie Carter, an account manager here at EDC and the moderator for today's discussion. Today we're talking about how to overcome export challenges. First, we'll look at the most common hurdles exporters face and then how to overcome them. Please note we're broadcasting today's session using simultaneous French translation, so if you'd like to listen en français, simply click on the Français button on your screen. Alors, pour notre auditoire francophone, nous offrons une traduction simultanée disponible sur votre écran. Veuillez tout simplement choisir le bouton Français. For those of you not familiar with EDC, we help Canadian companies of all sizes sell their products and services around the world. Every year, we help more than 7,000 Canadian businesses protect and grow their international sales. Today is the last of a series of 3 webinars, so if you missed the last 2, don't worry, they are now available to view on demand. So let's get started. On the panel today, we have 4 guests who will share their insights and experience with you. So I'll introduce them. First, we have Dominique Bergevin, Senior Underwriter here at EDC. Welcome, Dominique.
Thank you.
Calling in from his Toronto office is Phil Turi, General Counsel and Director of Global Business at the Canadian Manufacturers and Exporters Association. Welcome, Phil.
Thank you.
Also joining us from our EDC Toronto office is Jeff Keith. He's a Senior Financing Manager here at EDC. Welcome, Jeff.
Hi, good afternoon.
And last but not least, joining us by phone is Benoit Hubert, President of PJF Consultants. Bonjour, Benoit.
Bonjour, thanks for having me.
And I'd also like to welcome you, our participants. We're happy that you're able to join us today. During the next hour, we'll cover some of the most common challenges we hear from companies, such as how to find and keep international customers, how to manage risks, how to break into new markets, how to make sure that you're compliant with international rules and regulations, and also how to finance your export sales. We will then go to a question and answer period where you can ask questions to our guests live. So throughout the discussion, take notes and make sure you get answers to your questions later. Let's start with one of the top challenges exporters face, and that is ways to find and keep your customers happy. I'm going to play a short clip of an interview Dominique did with Alan Place, Vice President of Sales and Marketing at Quicksilk Inc. He will share with us his tips on finding and keeping customers.
Alan Place is the Vice President of Sales and Marketing for Quicksilk Inc., a company that makes software to help small and medium-sized businesses build websites. With 25 years of experience in international sales, Alan knows a thing or two about finding new customers. There are many ways of meeting new customers. You can go to a trade show, you can visit a market of interest, you can get a referral. What would you say is the best way to meet a new international customer?
As you point out, there are a number of ways of meeting them. One way that I particularly favor is trade shows. It can be an incredibly cost-effective way to be able to meet new customers. In addition, you're able to meet potential partners, alliances, or companies that you may wish to sell your product overseas if you're pursuing an indirect distribution strategy. The important point here is this. You need to work the trade show before you go. If you arrive there with a bag full of trade show trinkets and some business cards, you've largely wasted your time and money. Go to the exhibit website beforehand. Find out who the exhibitors are. Go to their websites and find out if you need to meet them. Are they competitors? Are they potential distributors or customers? And engage with them before you arrive, so that if people do come by your booth and find something of interest, great, that's gravy. But you've got an aggressive meeting schedule set up before your arrival.
Very interesting. So once you've landed that new customer, I guess the question then becomes, how do you retain the customer's loyalty and form a long-term, strong relationship with that customer?
That's a particularly difficult thing to do over distance. In its most simple terms, mind share is market share. If your customer wakes up every morning thinking your company's name, it will be as a direct result of the fact that, first of all, the product is doing what it was you said it was going to do when they bought it. But more importantly, you need to stay in touch with them. And this is one of the advantages of working with an indirect distribution channel. You can, to some degree, offload the responsibility for not only sales, but also, in some instances, support of the software. Irrespective of whether you sell direct or whether you're going through distribution channel, it's absolutely critical for a company to be in region, to travel in order to meet the customers, not only to make sure that they're satisfied, but also to meet new customers.
Mm-hmm. You mentioned about selling directly or indirectly. Is there a different approach that one company should take in meeting new customers based on their preferred distribution channel?
So I'll answer the question, but as a precursor to it, a company should consider selling directly when the product is expensive, the sales cycle is long, a year or 2 years, where there's going to be ongoing engagement with the manufacturer, where there's customization or training required. You can sell indirectly where the products are relatively inexpensive, the sales cycles are relatively short, and there isn't a great deal of need to engage with the manufacturer.
That makes sense.
So with that as a basis, if you've decided that you are going to sell indirectly, it's important to be able to engage on an ongoing basis with your distributors in order to be able to not only establish loyalty with them, but also to make sure that the end users, the customers that they're selling to, know that you're providing ongoing support to the distributors.
Thank you very much, Alan, for your expertise.
Thank you very much indeed. Pleasure to be here.
This clip emphasizes how important it is for companies to visit their market of interest and establish those long-lasting personal relationships. So, Dominique, we both know that doing business around the world can be risky. What are those risks that exporters do face?
Yes, well, thank you, Mélanie. When you're selling in Canada or doing business generally in Canada, you kind of understand the environment in which you're working. You understand the institutions, the rule of law, and it's easier to maybe get to know your customer. When you're going outside of Canada, it's different. The risk profile is heightened. As much as there are many opportunities to seize in doing business internationally, yet it's important to realize that the risk profile is different. And this is for many reasons, and I'd like to spend a bit of time talking about some of these reasons. The first is as simple as to say, well, it's harder to go knock on your buyer's door when your buyer is not accepting your goods or when they're just failing to pay. You just don't necessarily have that ease of access to them, out of sight, out of mind. And as Alan Place was mentioning in the interview I had with him, the importance of really having that local presence is really key in managing some of that risk. And that could be either direct or indirect, as Alan mentioned, through an agent. But having that local presence is important to understand also the different environment in which you're operating. So the legal environment, the regulatory environment, what are the bankruptcy laws, for example, so that is it easy for a company to declare bankruptcy and not have any obligations beyond that, or what is the environment? It's also important to get to know your customer. So the environment, your customer, what has been their history with regards to paying their suppliers, and ultimately, there's a lot of information out there available. There are places where you can go to get that information, looking at their financial statements as well, and having that local presence. Knowing also the cultural context is quite important. It really involves potentially changes to how you're playing in that market. So what are your products going to be? You might be serving a slightly different need in that market, and so you might have to adjust your product or your service. So that's a risk that you need to understand and build into your strategy. Beyond that, when you are doing business internationally, your contract will likely be in another currency than the Canadian dollar.
Right.
It could be in the US dollar or the euro, but ultimately it's about understanding that you're exposed to currency risk when you're doing business internationally. And that can quickly eat up a profit margin when you consider even the volatility that we've seen in the Canadian dollar versus the US dollar in the last year. It can be sometimes, 10% drop, which can quickly eat up a profit margin if you're not planning for it.
Right.
The other reality, and this is an area where I've personally focused a lot on, is the fact that the headlines remind us daily that the geopolitical environment globally is quite unpredictable. Political situations may seem stable and then overnight can change, and that can have an impact on your business. Thinking about the different types of risks that may evolve could be political violence. A country that has certain stability over quick amount of time can really go from civil strife to civil commotion to civil war and ultimately terrorism.
And we've seen that happen in the past few years.
Absolutely. If you think of the Middle East, for example, not that long ago it was an area of great stability. And now businesses who have gone into that area of the world have brought in capital to do their investments, have had to just abandon the market given the fact that the situation is no longer stable for them. Geopolitical risk can also translate into another type, which is economic risk, which if you're doing business in a market and your buyer basically is generating local currencies and then they need to pay you in a US dollar contract, they'll need to ultimately access US dollars locally. And so if a country is going through economic woes, they might not necessarily have hard currencies to give or to convert. And so your buyer, even though they're not bankrupt and they're willing to pay you, may just not be able to access the hard currency to pay you. If you hold money in a bank account in a foreign jurisdiction, you may also have to, or you will probably want to repatriate some of that funds back to Canada, and you'll be exposed to then the controls that any government may have put in place to restrict how much money can flow out of their country. So certain economies do this in order to protect capital flight from their market. You can think of Ukraine or Greece, who have recently had these situations, and the governments have played a role in minimizing the amount of money that can come out. Other countries will do this for political reasons. Venezuela in the past has had controls in place, other countries like Argentina, and ultimately the decisions that are going into who's accessing hard currency and who's allowed to get the money out of the country may be a politicized decision. So really when you are selling or bringing your assets into a foreign jurisdiction or bringing capital into a foreign jurisdiction, all of these risks are important to understand because you are exposed to them.
And be assessed, exactly. So what do companies do to overcome those risks then?
Well, I think the first step is really about identifying the risks.
Right.
Unfortunately, some companies will, be very excited by the fact that exports brings opportunities, and that's, a great space to be in. But it's also about realizing that some of the risks that we've talked about are a reality, and it's really to identify them and to then measure your exposure to that risk. So in identifying the risk, for example, of foreign currency fluctuations, it's important to even identify that risk early on when you're setting your prices. So if you're setting your prices at one spot in time at one currency rate, and then it takes you a bit of time to sell your goods, it takes you a few months from the time you set the price to the time you make the sale, and then the time you make the payment, 6 months could have gone by, and that price that you set is no longer the money that you're generating in Canadian equivalent.
Exactly,
so
the profit you thought you would make is no longer. Yeah.
And so you need to identify the risk at that time, and then measure your exposure to it. How much assets? What is the worth of your assets in that market? What is the maximum amount owed on a contract at any given time, or what is your contributed capital? So understanding how much you're exposed to the risk, and then ultimately this is really with the vision of then establishing a plan to manage some of these risks. And there's many ways that one can manage risk. Political risk, one of the basic ways of managing it is being in the market, getting that social license to operate in the market, making sure that you have buy-in from the government, buy-in from the local communities, and that will really help minimize certain political risk. But it's also about sometimes products and solutions that can help you manage the risk. So we were talking about foreign currency, engaging with your bank to get into a foreign exchange facility, which can give you access to hedging or forward type contracts, which helps you manage that foreign exchange risk. And at EDC, obviously, we have a number of insurance solutions that are available to help companies manage the risk. The risk that their buyer doesn't pay either because it's going bankrupt or it's refusing to pay, or ultimately because there are controls in place that are not allowing them to flow the money back to Canada, can be covered by our accounts receivable insurance. We also have political risk insurance that covers companies that are bringing equipment or have cash in foreign jurisdictions, or that are making equity investments in foreign jurisdictions. Right. So that can be covered. We have contract frustration insurance, where companies are entering into a contract, a single contract, and ultimately wanting to protect against frustration of that process. Mm-hmm. We have also bonding solutions. So EDC does really have a suite of products that can help, once you've established your risk mitigation plan, to really bring down that risk for the company.
That's great. Thank you for your insight, Dominique. That's much appreciated.
Pleasure.
Obviously, we see that many of these risks can cause a lot of headaches, and so thinking about them early is definitely the best way to go. So another challenge companies face is how to break into new markets. And we recently sat down with Emmanuel Gann, Vice President of Alam Advisory Group, a Canadian-based global strategy consulting firm. Emmanuel talks about ways Canadians can enter new markets and how to find opportunities there. Here's a short clip from that interview.
Hello, my name is Zenon Wojcichin. I'm with Export Development Canada, and I'm very pleased to be here today with Emmanuel Gann from the Alam Advisory Group to talk about opportunities for Canadian companies to access new markets internationally. Hi, Emmanuel. Welcome to EDC.
Thank you.
Which global markets currently present the best opportunities for Canadian companies to expand?
Well, the global marketplace is a wide open playing field, so there are many opportunities out there. We at AG, for example, are very active in markets like Europe, India, Southeast Asia, and the Middle East, but there are many other opportunities. There is no one-size-fits-all approach, no single answer to your question. What is important is to investigate the potential markets, get an idea of the potential of these markets, and have in place a business plan. That's what is the most important.
And what are the biggest barriers for Canadian companies to enter new markets?
The main barriers they face are in terms of market exchange volatility, the cost of shipping, the logistics involved in doing business with overseas markets, the legal requirements, the tax burden, but mainly, I would say the limited capacity to analyze markets and to know what are the opportunities out there, to identify business market opportunities, to understand the target markets and understand the requirements. Shortage of working capital is also often something that is mentioned. Risk aversion. And I would say cultural language barriers, which are also often mentioned as barriers to expand internationally.
What type of tools or services are available to help companies and address some of those issues?
I would say when it comes to international trade knowledge, understanding other markets, Canadian companies can rely on experienced professionals, people who can help them navigate the risks and opportunities, can help them understand foreign markets, help them understand the local rules, but also the local customs, the business culture, which is very important. It's a very important aspect. Understanding the foreign market you want to target. It can make or break your international ambitions. When it comes to risk aversion, I would say be brave. International expansion is risky. There's always an element of risk, but it can also be extremely rewarding, accelerate your revenue and growth. You need to have an international strategy. You need to have a business plan. Don't jump on a plane, go around the world and expect contracts to fall at your feet.
Thank you very much, Emmanuel.
Thank you.
I've been speaking with Emmanuel Gann of the Alam Advisory Group about opportunities for Canadian companies to access new markets.
So let's move on to Phil now and talk more in depth about one of the challenges mentioned by Emmanuel, and that is understanding the laws and regulations that need to be followed when selling into a new market. So Phil, tell us, how important is it for companies to understand all the rules and regulations applicable in different markets?
Well, thanks. It's actually very important, and I think that what you heard early on today on this call and then also in the video that just appeared kind of highlights the importance of understanding the rules and regulations selling into a new market, into an international market. It's important for companies to be making considerations when doing business internationally. Things like local labeling requirements, for example, often require companies to make certain disclosures. Sometimes those disclosures have to do with the contents of their products that they're selling into markets. They sometimes have to do with language and language requirements. Sometimes companies, particularly manufacturers selling into a new country, have to meet certain standards and have to provide markings on their products. For example, CE markings on a manufactured product have to be applied if you're going to be selling into the EU. Marking requirements all have to do with rules and regulations. Intellectual property, the protections that you have in a country, as well as the protections you'll need to acquire, are often impacted and almost exclusively impacted by the rules and regulations in a market. If you're selling to government, procurement rules and the rules and regulations that go into procurement also are heavily dependent on the rules and regulations of that jurisdiction. So there again is another set of rules that you would need to understand. If you're moving business professionals into and out of a country, there are oftentimes certain visas that come into play, and therefore understanding the rules and regulations that apply to the people you're moving into and out of countries when you're selling internationally is important, as well as the recourse you have if things go wrong. So oftentimes companies will have recourse in the contracts they have with a foreign buyer, and sometimes their recourses are impacted by free trade agreements, for example. So it's really important for companies to understand that they need to consult with local government websites. Usually it's a good place to start when doing business internationally. Usually countries have very good resources on their Ministry of Commerce or Ministry of Economic Development or investment websites, and every country has a different name for that. But it's important to take stock of what's out there publicly available on the websites, probably even before you engage your local counsel, your local lawyer that you're working with here in Canada, and also with local counsel in country. So what I wanted to do is really focus on, from a legal perspective, and I know you're all business people, making sure that you're asking the right questions. So this really comes down to addressing the big issue, which is you don't know what you don't know. And I always find that a lot of issues and questions that come up with respect to rules and regulations could be headed off simply by asking some important questions up front. Those include asking yourself whether or not the export destination that you're selling your product to, asking yourself whether or not that country is a member of the WTO, the World Trade Organization. Canada is a signatory to the WTO, and that affords companies selling to other WTO member states certain benefits, certain advantages that you need to be mindful of. You should also be asking whether or not the country you're selling to has an FTA or free trade agreement with Canada, whether that's a bilateral agreement or whether it's a multilateral agreement such as NAFTA. You should be asking and thinking about where your goods originate, because that will influence what rules and regulations apply to your product, particularly with respect to rules of origin. And also you should be asking yourself whether or not your products or services are subject to export controls. That will limit and impact your ability to sell into a foreign market. These are relevant questions because you may have to secure permits by CBSA, Customs and Border Services Agency here in Canada, to export a product. You may also have to secure permits from foreign customs agencies to sell your product. Mm-hmm. So I wanted to talk a little bit more about managing risk, and perhaps we should maybe move on to the next portion of my presentation.
Yes, exactly. Well, I was just going to say how obviously due diligence is definitely critical, and it is a complex topic, one that we could spend a whole hour on. But maybe give us the high-level tips on the key aspects company absolutely need to focus on as they're going into different markets.
Okay, so no problem. Regardless of because whatever governing law is chosen when you're contracting with someone internationally, you could use the UN Convention on the International Sale of Goods. You could be using the UCC, or you could be using national laws to govern your contracts with a foreign entity. There are some important things to keep in mind. You need to be thinking about in any contract with a foreign buyer, who are the legal parties? We talked a little bit earlier about issues around potential bankruptcies, right? It's important for you to know who you're doing business with. It's important to analyze with your foreign customer or foreign buyer when ownership should transfer, when ownership of your goods should transfer, when goods might be rejected, the origin of goods, what price, the manner and date of payments. There's various ways to manage risk, but those are questions that oftentimes can be addressed through financial products, and using and working with EDC, I think, is very important for that. But keep in mind that a lot of these things can also be managed within your contracts. That being said, I think it's also difficult to predict factors that could come up that could impact your sale. So, for example, there could be an unexpected price increase from a supplier. There could be a bankruptcy of a supplier. There could be an unwanted strike or a simple misunderstanding in pricing and quoting. You need to include clauses in your contract to deal with risk-laden situations. Generally, you can group these clauses into areas. So there are clauses that can suspend liability. There are clauses that can allow for future events and contingencies, and there are clauses that impose or shifting liability. And finally, you need to also keep a careful mind to dispute resolution, because oftentimes I get calls from companies who are not able to work with someone or perhaps are waiting on products or goods to be delivered. That's a situation that leads to a dispute, and questions then arise on whether or not they can go to court, whether or not this should go to arbitration. Mm-hmm. All of these things could have been headed off inside a contract. So it's important to work with your counsel here locally in Canada or internationally. If you are, and I don't know how I'm doing for time, should I be moving on to some of the resources?
There's more than enough time, and there'll also be some time for people to ask questions for later on. So this is relevant information. We appreciate it.
Okay, so I wanted to say a couple things, because I mentioned clauses that suspend liability. So one of the things you might want to talk to your lawyer about is an exemption clause. Having an exemption clause in any international sale of goods contract excuses certain breaches from liability, and oftentimes provides for some curing action. So if there's a potential default, or it sounds like your foreign buyer, for example, is not going to be able to make payment, oftentimes you can head off or buy them some time, if you will, in a contract, and allow for them to take some curing actions so that the contract isn't voided for breach. We heard earlier about foreign exchange risk. Price escalation oftentimes can be impacted by foreign exchange risk. Mm-hmm. Oftentimes, good contracts have a price escalation clause in them, and that stipulates a floating sale price determined in accordance with a formula that the parties typically agree to in advance. So that's something that would really help, in addition to working with EDC and others out there that can help you manage foreign exchange risk.
Right.
Having that type of clause within your contract is important.
That's a really, really good point. So do you start, so you mentioned working with an international firm. Do you start with the domestic lawyer, or do you go directly for an agent or a lawyer that's in the jurisdiction while you're going to be doing the business?
So that's a good question. So it depends on who you are. It depends on who you typically work with. It depends on your experience with respect to exporting. Mm-hmm. Oftentimes, local counsel here in Canada have international offices. We have the benefit of, in Canada, of having Canadian firms that have international connections, and so oftentimes they have representation in markets. So you would start with your local counsel, and they could oftentimes tap into their office in the EU or in the U.S. If you don't have that type of firm working with you, another great place to start is to reach out to the Trade Commissioner Service. The Canadian Trade Commissioner Service is part of the government here in Canada, but they have folks posted all over the world at our embassies, and they typically have a pretty good list of local counsel that you could work with, that they have experience with, that they've referred other Canadian customers or clients to, and that would be another good place to start if you want to look for local counsel in a foreign country.
That's a really fair point. So is there another resource that people could go to get more information on compliance?
Yeah, so definitely, usually exporters start with the U.S. Oftentimes they look at the EU or Mexico. It's important to take stock of those countries equivalent to our CBSA. So in the U.S., for example, it's Customs and Border Protection. Their website includes a whole section for Canadian companies that need to be aware of selling into the U.S. market. So there's a pretty good summary of all of the rules and regulations that would apply to you if you're selling into the U.S.
And where is that? Sorry, can you mention it again? Can I ask you to mention it again?
The URL is www.c as in Christopher, B as in Bob, P as in Philip, .gov.
Okay, great, thank you.
That's the URL for the U.S. and for the EU. A great place. It's a new website that was launched by the European Commission. It's the Export Help Desk, and it has a very good summary of all the rules and regulations you should be aware of if you're selling into the EU. That URL is exporthelp, EXPORTHELP .europa.eu. So that's another really helpful resource as well if you're selling into the EU market and you're concerned about rules and regulations.
Great. And then tapping into the CME is also a great place to go when you're, going into different markets. Seeing what you guys have to offer, the advice and so on that you have to share is also a great place to be.
Yes, thanks for reminding me. Yes, anytime you need assistance, the CME website is cme-mec.ca, and my team would be more than happy to help connect you to any one of the folks I mentioned earlier.
That's great. Thank you so much, Phil. So the last challenge we'd like to cover today is how to access financing. For example, a company may have a potential sale with a new customer, but they don't necessarily have the working capital to take it on. Or a company may want to set up a sales office or a production facility outside of Canada and need the money to make it happen. So Jeff, as a financing manager, I'm going to ask you this. How often do you hear stories like those that I just mentioned?
Yeah, Melanie, we hear those stories all the time. There's opportunities and rewards for companies exporting and doing business internationally, but of course, with those opportunities, there are challenges, including the financing challenges. The Canadian banking system is really strong, but there are times when an opportunity a company has doesn't quite fit within the banking structure they have now. And a few examples come to mind that we see. You mentioned one is a large purchase order. Potentially the Canadian company's operating line just can't support the cost they need for this large export sale, and the company's trying to figure out how to complete this sale, how to fund the cost they need. Secondly, we see fast-growing companies that need to increase the size of their operating line, or they need to actually add an operating line. Maybe they're a newer company that they don't yet have an operating line. And a third challenge you alluded to is Canadian companies may be setting up an office in Mexico, the US, internationally. Maybe they're getting closer to their customers. But the reality is sometimes banks are not comfortable lending against assets outside of Canada. So those are three common challenges we see on a daily basis.
So when the banks are not necessarily comfortable and the company doesn't have the financing to proceed, where can they turn for help?
Yeah, we never want to see a company turn down growth opportunities because they don't know what to do. So I always recommend, talk to EDC, and there are different ways we can help on the financing side and in other ways. But on the financing side, I think of four main buckets. The first area actually is to work with the bank. We have lots of ways we can partner with a bank, including loan guarantees. We can guarantee a portion of the bank's loan to a company, and there's different ways we do this. It could be to guarantee the operating line, to increase the operating line. It could be to guarantee a loan facility that's set up to help fund the costs of a large purchase order. So there's a lot of ways we partner with banks. And of course, under this program, we have to make sure it fits within the bank's parameters. There has to be some kind of export angle for EDC to be involved, but we do this all the time. The second area we can help is actually, if the guarantee doesn't work, EDC can be a lender. We can actually lend to the company to support their export sale, the export opportunity. We always pursue the bank partnership option first, but if your bank prefers that we are the lender, we can find ways to do that. A very common way to do that is to support assets going outside of Canada, so the expansion of a facility in the US or Mexico, for example. So that's another way we can help. A third way we can help actually is our insurance solutions. So Dominique had talked about all the different forms of insurance we have, but sometimes they can actually help you access more financing. So what I mean by that, for example, is if you have sales to Canadian and American buyers, your bank may be comfortable giving you lending value against those accounts receivable. However, if you start selling to markets like China, Mexico, Europe, your bank may not be comfortable giving you any lending value against those accounts receivable unless they're insured. If they're insured, your bank can get much more comfortable giving you lending value. We also see things with political risks depending on where you're operating. Maybe you have a subsidiary in a challenging market, and that causes some heartache for your bank. Political risk insurance can make it easier for your bank to give you the lending you need by helping mitigate some of the risks that the bank is looking at. Dominique also talked about bonding. We have ways to basically insure or guarantee standby letters of credit. So maybe you have a large contract and you have to post a performance guarantee or an advance payment guarantee. Your bank is happy to do so, but your bank may also want to take cash collateral or some other kind of collateral for that guarantee. However, if EDC is able to partner with the bank on a solution, the bank may not need to take that working capital from you, that you can then redeploy that working capital to help grow your business. So that's kind of the third way. And fourth, really, if EDC is not the right option, we do have a great partner network, whether it's banks, partners like the CME, consultants, trade commissioners. So we're happy to make those introductions for you to the right partner. So really, Melanie, those are the four areas I see EDC can help with these challenges.
That's great. It does sound like there's a solution to many financing issues or heartaches out there. So I'll ask you, where do a company go to get more information on the solutions, Jeff?
Yeah, there's a few places to go. Our website, edc.ca, has a lot of solutions listed. I mean, I only do the tip of the iceberg for some of our solutions, but edc.ca has more solutions. We have market intelligence there. We have white papers on countries. That's your first place to go, unless you have an existing account manager with EDC. If you do, I would suggest you reach out to them first. If not, you can get contact details on our website. And also ask your banker. Ask your bank if they know EDC, if they work with EDC, if you and your bank should be approaching EDC to help you grow internationally.
That's great. So in closing to what you just mentioned, I said at the beginning that we, EDC, supported about 7,000 companies last year. And I'll say that about 80 of those are SMEs, small and medium-sized enterprises, right? So 80%, exactly 80% of the 7,000. So that's a huge number. It's a gap that we see exists in terms of finding solutions for exporters to be successful, and we certainly attempt to fill those gaps. So thank you for your insights, Jeff. There's obviously a lot of due diligence and planning involved before you start exporting, as we've seen in the last about 40 minutes here. So, what are the rewards? We ask ourselves, right? So let's ask Benoit Hubert, president of PGF Consultants. Benoit, please tell us a little bit about your company to start.
Hi, Melanie. Great. PGF Consultants was created in 1988. We're a small boutique shop based in Ottawa that does management consulting, essentially. So we're into exporting services. We export sort of help with strategic planning, operational planning, policy development, and sort of building the leadership and team management skills that public institutions need to build to meet their targets and strategies.
Excellent. And so how and why did you ever decide to start exporting?
It initially began with, I would say, an intuition and a passion from our past owner and founder of PGF. There were ideas that were floating around that we could certainly bring expertise abroad with tapping into the Canadian knowledge that we initially had and were developed around the fishing industry, where it all began for us in Morocco. So that was our first international experience over about 20 years ago. Now the second experience was in Romania, where we helped the national government think about decentralization and giving powers to the different regions within the country. And that project spanned for almost 3 to 5 years, and we had the staff on the ground. We then moved on to a bigger project for CETA at the time, which was organized in Iraq. And this was post-war context in Iraq, and the question was around minorities and how do you consider minorities within government. And so this was around sort of them getting their heads and having initial discussions, which then brought us about 10 years ago to Western and Central Africa, where we've been essentially doing work with regional organizations, helping them develop their strategies and their plans and to get them operationalized as they seek to better integrate their economies and to sort of help their countries grow in itself. So it's been a long and winding journey, but I guess our motivation is really to sort of bring Canadian expertise abroad and to also help us see differently the world and how we could also improve our ways of managing here in the country.
That's great. So would you say that exporting today is a focus?
It is, absolutely. It's been more than 50% of our business for the past 2-3 years, and we're expecting that to grow in the next coming years as well.
That's great. So as you've been dealing in different markets like this, what has been the biggest challenge that you've faced, and what did you learn from it?
Well, it's interesting. They were already mentioned by Dominique and Jeff, but geopolitical risks were very important for us. We've been working in Burkina Faso, a small West African state that just went through a few important years of political movements, but seems to be stabilized. So that was quite a risk in itself. So we, taking into consideration what the context is and looking at the DFAT sort of warnings to moving abroad, we've taken that into consideration and tried to manage the risk as best we could. So in this sense, the accounts receivable insurance that EDC could offer was extremely helpful for us. The second risk I could mention is one of the limits to our banks' willingness to actually support us abroad. Because of their limited knowledge and understanding of the risks of exporting, as was already mentioned. So the financing elements here were extremely important. So we were able to obtain a performance security guarantee by EDC, which totally secured our banking institution and allowed us to move forward. A third challenge that we faced was also the scoping of our work, because it's one thing to understand what a client wants in Canada and to be able to go and meet them wherever they are in the country here, which is relatively easy. But when it's halfway across the world, you want to make sure that you agree on the deliverables and the timelines. And so we decided that we would spend and invest the money to go and meet the clients before signing the contract to make sure that we both agree, especially that, in the context of the service industry, you want to get a clear understanding of exactly what is expected. So that was another challenge that we've overcome. And the last one is always, I would say, just around the sort of human relationships that you need to build and understanding the culture in which you're actually going to be working in and what the intricacies of the human connections are. And so building those relations was extremely important and key for us, and actually really helped to untangle some issues we had to overcome over time.
That's great. So before we turn to the questions and answer period, Benoit, if you could, would you sum up the top 3 things companies need to know before they start exporting?
I think the first thing for me would be to be patient, really take your time and focus and to see exactly what you want to do, where you want to do. And so developing a really good strategy as to what you want to do and where. Mm-hmm. Think hard about the cash flow and the financing conditions as well that are required. And really think hard as well about building the relationships that are required to deliver your product or your service wherever you're working in.
Thank you very much, Benoit, for sharing your insights. So today we've heard some great tips, and we really hope that you can use some of those to build on your own export strategy. And don't forget, whether you're currently exporting or thinking of getting started, as mentioned throughout this session, we have a suite of products and solutions that are available to you, from protecting you against not getting paid to helping you gain access to more financing and working capital from your bank with our guarantees. So if you have any questions, please don't hesitate to give us a call at 1-800 229-0575. So let's move on to the question period. We'll try to squeeze in as many as possible. So to ask a question, please click on the Q&A button on the lower left-hand side of your screen. And let's begin. So first question is for you, Benoit. How did you build the strong relationships with your customers?
I think it was built initially through time. So taking the time to meet with the clients and to meet, well, initially in Africa for us, it became really important to build time in sort of building the human relationship before the business relationship. And so just being available, taking the time, and really trying to understand the issue, and not just coming in and out, but actually really being vested in the relationship.
That's a fair point, and it bridges nicely with one of the 3 tips that you gave. Being patient was one of them, right? So Dominique, next one is going to be for you. So are there any particular countries which should be worried in terms of political instability?
I mean, the world is a vast place. There's almost 200 countries in the world, and each has their own profile when it comes to political risk. And political risk is also quite broad. So you think of the economic risk, you think of the political violence risk, and the government intervention risk. Mm-hmm. So when we look at the map of the world, we actually, economics, our EDC economics departments do produce a quarterly report called the CRQ, quarterly report on country risk, basically. And they have these maps of the world with all of the countries color-coded based on the level of risk. So if you're thinking of economic risk, so which could translate into transfer and conversion issues, you basically go to this report, which is available on our website, and you can look at all the ones that are red and understand that that's what is the key risk driver in those markets. Whereas if you're looking at political violence, it might be a whole other slew of countries that are more red. But EDC definitely has people that are monitoring these risks on a continuous basis and producing information for exporters to access and to make informed decisions as you're exploring a market. So really encourage you to go into our website and find this quarterly report and any other material that we produce to profile country risk for you.
Thank you so much for your insights, Dominique. Phil, the next one is for you. So do you have advice about not working with countries that are not into the WTO?
So if there are countries that you're thinking about, businesses within countries that you're perhaps going to sell to or work with, and they're not WTO signatories, that just means that there are some less things governing the contract, and in many respects, your recourse, if things go wrong, would be different. Trade preferences, so tariff preferences, for example, would obviously not be there. However, if it's a country that Canada has an FTA with, and that country is, let's say, not part of WTO, then that might be okay. So that's not to say that you should turn away from countries that are not signatories to the WTO. It just means you may have less options, and it may impact things like pricing and what have you. So if you are going to be doing business with a company that's not part of the WTO system, that just means you're going to have to make sure that contract you've got with that foreign buyer or foreign supplier is absolutely tight and includes some of the things that I was mentioning earlier, and also making sure you're spending more time with your local counsel here in Canada or abroad. You're spending time with them to make sure that those contracts are tight. So I'm not sure if that helps at all, but
absolutely. No, that's great. Great insights.
Yeah.
Yes, thank you. Going back to Benoit, somebody asks, how did you go about and find your customers overseas?
Thank you for the question. What we had done actually was that identifying Western Africa as the region where we wanted to work, we established 2 partnerships with firms in the region, and we worked jointly to develop potential clients. And so we did a few initial missions abroad and met with different government departments and organizations to pitch our services and at least get on their mailing list of potential business. And then we were able to submit proposals, get our experience in. And so it all stemmed from having contacts in the region and taking the chance to actually go over and to meet with different people and organizations and to get our feet in the door.
Excellent. That's a great. So you had a plan going in. You weren't just being reactive. You were really proactive about this.
We were proactive. I'd like to say that everything was, well organized and we had a great plan. Part of it is true, but part of it is intuition and a bit of luck and a bit of determination and courage as well to go and to take the chance. So it's nice to have a good plan well spelled out, but part of it's got to be about, taking chances and to just go and try things out.
That's great. Thank you. So my next question is to you, Jeff. Somebody asks if you can get insurance only for one contract or one buyer, and also asks whether or not EDC helps doing credit checks or due diligence on clients, on buyers.
Yeah, sure. EDC can customize our insurance solutions in a lot of ways, including doing a single buyer, a single contract. We don't require you to insure your full book of business. I mean, if that's not what you need, then of course we'll try and find a solution that works for you and your business, realizing every company is different. And sorry, I forget the second question, Melanie.
So
Was it about credit checks?
So it was really about is the policy, the EDC policy, flexible, and can we help with due diligence and credit checks on buyers?
There's different ways we can do that, but one way you could get comfort is just knowing if we are able to provide insurance. Knowing that we could provide the insurance, whether you actually take the insurance or not, should bring some peace of mind. So that's one way we can do it.
Absolutely. I would totally agree. In fact, just to talk a little bit about the logistics of the policy, when you come into EDC with a contract, you tell us the amount of it and how much you need to insure, and the EDC would do the due diligence on your behalf, and we would come back with an answer as to yes or no, we can approve the required limit, or we'll come in with a smaller limit, and that is advice that you have to work with, right? I mean, it'll tell you if you can go ahead and sell and ship or offer your services with peace and comfort, or maybe if you should be asking for a bigger advance payment because EDC can't protect you against the risk, right? That is telling. So definitely EDC, through its insurance policy, can support you with your buyers and helping with due diligence, but we don't have a mechanism that specifically gives you credit checks on companies. Duns & Bradstreet, for example, is one that would do so, and there are many international credit agencies that would support in terms of that. So, as the next question, Dominique, you spoke about currency fluctuations. So, someone asks, how can one protect themselves against currency fluctuation? And that could be addressed to you and to anyone else on the panel, in fact, if they have experience.
I actually think that Phil offered some interesting insight on that in his discussion, where he was saying that there's opportunity to actually build it into the contract and have a sliding scale for your price. And so that's if you're successful in doing that, that definitely helps. And alternatively, I had mentioned that leveraging your bank and seeing the solutions that either your bank or certain specialty companies may have with regards to hedging instruments, where for a price you could guarantee the amount of Canadian dollars that you would get at any exchange at a specific exchange rate. So those instruments do exist. And in some cases, when you do leverage those types of instruments, the bank is also asking you to have a certain amount as security, and EDC can also come and help there in freeing up that security. So talking to your bank is one option, and as Phil alluded to, and maybe Phil can speak more to this, is having it as a line of sight when you're even setting your price and negotiating your contract is even better.
Phil, did you want to add to this?
Sorry, my line was muted. My line was muted. Yes.
Sure.
Yeah. No. I mean that is definitely something. As I was mentioning earlier, I mean, oftentimes, people typically think about exporters. Typically think about working with an outside institution, working with a bank, as they should when it comes to trying to manage risks with respect to pricing. But sometimes people lose sight of the fact that you can have a price escalation clause, which really just means you and your buyer or supplier will agree to basically a sliding scale or a formula in advance, especially when you're working with someone or you have a customer over a very long period of time where, the cost of performing a contract can change over, let's say, the lifetime of a contract. It's helpful to have these types of clauses in place. So, for example, if a supplier has agreed to provide a foreign buyer with goods on an ongoing or even like an intermittent basis, and the negotiated price for the goods today are not necessarily reflective of what's down the road, having a pre-established formula in place is helpful and can sometimes head off some disagreements and disputes that could arise down the road. That's
great. I have another question here that could potentially be addressed to anyone, so please chime in. And the company here or the audience asks, what if you're just starting out and can't afford a local presence in a particular country? How do you go about being successful? Phil, can I throw it back at you to start?
Yeah, sure. So the benefit of, I guess, working at CME is we work with so many different companies that are in that same situation. So if you can't afford to have a local presence in a market, and that's really, as was indicated earlier on in the course of this whole webinar, having a presence is important because it helps you show that you're committed to the market, it helps you get a better understanding and better comfort and familiarity with who you're selling to, for example, or buying from. But if you don't have the resources for that, some things you should be thinking about are working with agents, right? Working with sales agents, working with representatives in market. And those are different than working with distributors. So working with a distributor typically requires some upfront money, some upfront payment, some training, let's say, whereas and oftentimes they're buying the product from you and selling it to someone else. Whereas when you're working with a sales agent, they oftentimes will work on a commission basis, and so there's not necessarily a requirement up front financially from you to invest in the sales agent. They can be your representative on the ground in market. Now, that obviously assumes you know the person, you trust them. It also assumes that you're going to be giving them sufficient training so that they could speak intelligently and knowledgeably about your products or services. A good place to start when it comes to identifying a local representative is, again, the trade commissioners. I mentioned them earlier. Also, EDC has offices around the world, and so it's important to reach out to those two organizations. I know that the trade commissioners do have local relationships with sales agents that have acted for or are currently acting for Canadian companies in market, so they're also a good place to start. And also keep in mind that the trade commissioners can kind of be your informal trade sales agents as well, because they are great advocates for Canadian products and services. And so making sure that they know you and they know what you are selling is really helpful as well, and very cost effective, as it's a free service for Canadian companies.
That's good. Benoit, I'll turn that back to you. May I ask if you have any international offices, or if you're only headquartered here in Ottawa?
Yes, we're only headquartered here in Ottawa. I was going to say, I think Jeff's points are very relevant. We've never had an office abroad, so we've always had partners on the ground with which we worked and with whom we have, daily discussions and adjustments of strategies and all. So I think it's totally possible and feasible to work without necessarily having a full-time presence on the ground. That's not to say that, you don't necessarily have to go once in a while, I think that's important as well to build the relationship and to, to demonstrate that you do exist. But I think that there are ways around that.
That's great. We have time just for one last question, and I'll turn it to Phil again. Somebody asks if the CME has a white paper that suggests points to be covered in a contract, or if you review contracts on customers' behalf, and if so, where can they go?
So we don't have a white paper, although we do have lots of resources that I can make available. We don't review companies. We don't do any legal work for any of the companies that are members of ours. We can make tons of referrals if that's needed, but I wish it was that easy to bring in business. But no, we don't do any legal work for any of our members, although we can hook you up with a lot of different resources. We don't have any single one white paper, although we've got one-off briefing notes and helpful resources that I'd be happy to make available. Best way to reach us, again, is at cme-mec.ca, or you can reach out to me directly. My email address is philip with one L, .turi, Turi, at cme-mec.ca.
That's great. Thank you, Phil. And that was all the time we had for today. But if we didn't get your question, please feel free to contact us by email at info@edc.ca. And again, that's info@edc.ca, or call us at 1-800-229-0575. Thank you to all our guest speakers today, and thank you, audience, for joining us through this webinar.